Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Friday, everybody. We're back with 15 minutes of some finance. We have a lot to cover today just because, well, one, the stock market has been doing terrible, and also because we have a Fed rate discussion coming up, I think like the 18th, somewhere around there. We'll get into the news here and see. But because we're on that topic, let's talk about a term of the day that's going to help you understand the Fed interest rates just a little bit more. And that term is basis point. So basis point, it's just a term of measurement, okay? It's just like a liter or a fraction or a mile, right? It's just a measurement of something. And so a basis point is 1/100th of one. Okay, and I know that gets crazy. That gets crazy. 1/100th of one. So like if I say 70 basis points, okay, that would be 70% of 1%. Okay, so 70 bips is another term for basis points, is a 0.7% fee. Okay, so basis points, you might hear, oh, they're going to do a 25 basis points cut. That's 1/4%. All right, and it gets really confusing. I remember when I took my exams, 10 years ago, and I think out of like the 210 questions or 180 questions, I don't remember how it was. There's a lot of questions. Like 3 or 5 of them, which is a lot for such a small thing, right? For just one, for really essentially what is a basis point, there was like 5 questions around them. So it's not you if it's confusing. It's meant to be confusing, okay? But a basis point is just 0.25 or 0.01%. Okay, 0.01%. So 1/100th of 1% is a basis point. And I think if you wanted to do it by decimals, and boy, I did not write this out before I'm saying it, but I'm pretty confident it's correct. It's 0.0001. I'm pretty confident that that's how you would do it. Because 0.1 would be 10%, right, of 1. So again, it gets confusing, but just remember that basis point is 1/100th of 1. So it would be 1% of 1. So 25 basis points means 1/4%. So when we hear the Fed rate maybe drop or mention dropping 25 basis points, you can go ahead and you say, oh, that's 1/4%. So that's pretty good, and you might sound smarter at the next dinner. Who knows? Okay, guys, let's get into the actual news. Today has just been sad. Okay, it's been a tough week, been a tough start to September, to be entirely honest with you, and it hasn't been easy for our firm. It hasn't been easy for any firm, honestly. Pretty much everybody struggled. But let me just get right into the news, and then we'll talk about that after. Major indexes were sharply lower in afternoon trading Friday after the eagerly anticipated August employment report underscored labor market weakness and spurred further debate about how aggressive the Fed will be when it starts cutting interest rates. The S&P 500 and the NASDAQ Composite were down 1.6 and 2.4% respectively, as tech stocks sold off sharply while the Dow Jones Industrial Average was off 0.9%. The S&P 500 is closed lower in 3 consecutive sessions. Session is just a day, guys. And all 3 major indexes are poised to post lower for the first week of September. U.S. stocks have gotten off to a sluggish start this month as concerns about health of the economy have resurfaced, with market participants scrutinizing every data release closely. Employment indicators have taken on particular importance as Fed officials have increasingly highlighted concerns about a cooling labor market as a primary factor for influencing their decisions as they consider cutting interest rates for the first time in 4 years. The August jobs report from the Labor Department, releases early Friday, showed that the U.S. employers added 142,000 jobs last month, up from the downgraded revised version July figure of 89,000, but lower than 161,000 figure that the economists had expected. The unemployment rate fell to 4.2% in August, down from 4.3% the month before, and that was in line with expectations. Shortly after the release of the data, market participants were pricing in a more than 50% likelihood that the Fed would cut its influential Fed rate by 0.5% at its next policy meeting on September 18th, according to the CME Group's FedWatch tool, which forecasts rate movement based on Fed funds futures trading data. In recent trading, however, the likelihood had fallen to around 27%, which is lower than where it was before the jobs report came out. Fed Chair Jerome Powell has signaled that the rate cuts would come as soon as this month, but he has stressed that incoming data will drive the decision on the pace and depth of the easing. The yield on the 10-year Treasury, which is tightly correlated to expectations around where interest rates are headed, was at 3.71% after falling as low as 3.66%, its lowest level in more than a year. Among stocks on the move Friday, AI investor favorite and our favorite, NVIDIA, was down 4.4%, leading a broader downturn for mega-cap tech stocks. Apple, Alphabet, which is Google, Meta, which is Facebook, Amazon, and Microsoft were all moving lower. Shares in Broadcom, AVGO is their ticker, were down more than 9%, leading the S&P 500 decliners. After the chip-making giant reported quarterly results that topped analysts' expectations, but issued a revenue outlook that disappointed investors. The iShares Semiconductor ETF, SOXX, was down 4.2%. Gold futures were down about 1% to around 2,520, while Bitcoin fell around 54,000, its lowest level in a month. Okay, look. I had said before I read the news that it's just been a bad month. Let me look at exactly what the S&P 500 is right now, this very second. Okay, so it's at 5,407.01, and all week, so it's dropped about almost exactly 200 points. How do I say this? Well, first off, there hasn't been an episode in the last 6 months that I haven't said we were going to expect volatility. A 200-point swing is volatility. It's big. Okay, one of the biggest factors that we're going to have for growth stocks, okay, is going to be the AI sector. The AI sector is just very important, especially NVIDIA. It's basically the trailblazer for the whole industry. Where NVIDIA goes, a lot of other companies go. And we had a great, maybe it started in November, but I know for sure it started in December. Just sometime in the winter of last year, at the beginning of winter, and pretty much for like the next 6 months. So we're talking November, December, all the way till maybe May, maybe even June. It was just climbing the mountain for these tech stocks. Pretty much every single tech stock was on its way up, especially if you were in the AI semiconductor space. So with that, there's going to be volatility. These things have to level out, right? We all have FOMO. Everybody has FOMO. So that's what happens with these things. The AI tech giants shoot up off of good earnings, good reports, purchase orders. Purchase orders is huge because they can't make enough chips to sell right away, right? They can't make programs, etc. right away. So when they get purchase orders, it's somebody saying, hey, we'll pay for this now, you'll deliver it later. And all that stuff is programmed into these businesses, but we don't really see all that, those intricacies. Okay, there's a lot of future pricing pushed in. And so when that happens, the stock goes up. Okay, even though they haven't delivered a product. Then you have FOMO investors, people who see the stock going up and think it's going to go higher. So then they dump money into it. And then once the deliveries happen, okay, now it starts to taper off because that was the business. And now they're waiting for more purchase orders, more deliveries to occur. And then you'll have more fear investors. And it's just this whole big cycle, okay, with the AI stocks. And the only reason I'm bringing them up is because I think our newsletter, I think it's like 5. Every month we pick a stock we like to watch. It's definitely worth investing in as far as we're concerned. Not investment advice, but we think it's worth investing in. And I think 6 of the 9 were tech stocks. Okay, so I think last week, 2 weeks ago, I told you guys our newsletter performance had been up near 60% on the year. S&P was about 20. Well, now because of this giant drop off, it's more like 40%, right? It might even be in the 30s at this point with how bad things are going. But I bring that all up just to show that this volatility, this is a part of the game. You've got to be able to play the game. And although when we pick stocks, when I tell you, hey, I really like SoundHound, or hey, Palantir looks really good, I'm looking at those stocks from a perspective of how elastic is the holding, meaning I want to hold it for a really long time. I don't want to buy and sell stuff. Okay, there's just too much guessing in that, and that's what happens with this volatility, right? Everybody gets scared. Some people get out. Some people buy more. And you just don't really know. You have to wait. And that's why when we pick stocks, we're picking things that are 5, 10, 15, 20 years in the making. If you look at any successful computer company right now, anyone, okay, well, let's just randomly pick one. Let's pick Microsoft. Let me just look up Microsoft. Okay, and I go to their life, right? I'm just on my Apple stocks on my iPhone, and I'm just looking at the life of the stock. Okay, they were created in 1986. Okay, so 17 cents is what this says, and now they're at 494 cents. Okay, so 1986, basically we're talking 40 years. Okay, 40 years it took for Microsoft to really hit it. And you can say, okay, maybe in like 2005, they were like let's go to 2005. They were a well-known company, right? They were $27 in 2005. Okay, so still massive growth, but even then, that took 20 years. Okay, 20 years. There is no stock that I can think of. GameStop and AMC are the most recent wonder stocks, and that does not happen. For every millionaire from those, there are 10,000 people who lost 50 grand, 10 grand, 20 grand, right? Because they put some money in and was like, maybe it'll keep going up. This is not a game. Okay, you have to know what you're investing in. And when you buy a stock, you have to really know, or at least work with someone who knows why that stock has a 10 life, a 20-year life. Those are the important things. If you guys are buying stock and you're trying to flip and trade them, I don't know anybody, not a single person who's really made money. Okay, most of them are at even because it took them 10 years to figure it out, and now they're just now starting to make some money. And maybe eventually they make it, but that's also their whole job. Right. And so I know I'm ranting here, but I just wanted to go off on that because the stock market right now it's a volatile mess, and it's going to keep being that way. We have an election that we have no idea what's going to happen coming up. And also the second half of the year for pretty much every year that we've ever kept track of the stock market has been bad. Okay. And I don't mean bad like it's in the negative. It's just done less well than the first 6 months. So the second 6 months almost always does less than the first 6 months of the year. I can't tell you why that is. I have no idea. But it's also an election year. We have wars going on. There's a whole bunch of stuff. But the most important thing that I would tell everybody is that there is more cash on the sidelines right now than ever before. They're waiting. They're waiting to put it in the stock market. They're waiting to put it in these fixed income securities. There is a lot of opportunity. And if you try to time it, maybe you're right, maybe you're perfect. But if you don't need the money for 5, 10, 15 years, then what's the point of trying to time it? Okay, just play the game. Be in on it. Yeah, and then again, I would tell you, most of you, 80% S&P 500, and then 10% Treasury, and then 10% if you want to mess around. You like Apple, you like whatever, Nvidia, any of these. Me and Brandon, the CPA at our firm, co-owner with me, we met with a fireman who had like 600 grand. Okay. And he was like doing it all himself. He had like 90% Apple stock. And he's like, well, what's the difference between you doing it and me doing it? And the difference is that we have an intense fundamental and technical. Sorry, I'm all over the place this morning. I had the largest coffee I've ever had. We have a fundamental and technical analysis approach for every equity we do. And we have evidence of that through our newsletter. So every newsletter we do, we're picking a stock and we're analyzing it and telling you the good and the bad. Okay. And so that is the job that we do. Now we also help you with financial planning and, what do you want your money to do for you? Do we want to make income? Do we want it to grow, et cetera, et cetera? But the biggest difference is like that. This is what we do. It's no different than changing your oil, right? Like you can change your own oil, but it's pretty convenient if you just have someone go do it for $50. So that's what I would tell anybody who's like, well, why would I work with a professional? Why would I have someone else do it? Because they're the experts. That's why. This is the job. This is the life. And also when you manage your own money, which is fine. I kind of am impressed by people who can do it. because it's a demanding job. You just get emotional about it. You make a lot of emotional decisions, and historically, people and emotions and important decisions don't go well together. So that's the rub on the stock market as far as where we think it's going. Again, I still think it's going to be positive. I think we're looking at 6,500, 7,000 next year. It's at 5,400 right now. So we're looking at a pretty big increase, 10, 20, 30% within the next, whatever it is, 12 to 18 months. We're really positive on the outlook. What is that going to do in the next 2-3 months? I have no idea. I couldn't tell you. And if there's anybody who does tell you that they know what they're doing, they don't. Don't listen to them. Just, I would tell you it's better to play the game than to wait on the sidelines and wait for your opportunity. You could be right, but if you're in the game, you're always going to be right. Okay, you're always going to be right. As long as you have time, right? If you're retiring next year and you have $1 million, don't put $1 million in the stock market. There's a whole bunch of other things that hopefully your financial advisor would do for you and with you. Let's see. Is there anything else I wanted to talk about with you guys today? Our September newsletter came out, and we had, let's see, how many people. When we started at the beginning of the year, what did we do? We had, what were our positions? We had Qualcomm, we had Kava, Palantir, NVIDIA. Why am I forgetting? Costco, I think, was on there. I got to look at all of them. But if you look at all of those positions, right, and you invested when we said to invest, or if you started watching when we told you to start watching, you would see an insane graph. Okay, especially Kava. I think Kava's up 55% on the year. Okay. Oh, and we had Chubb Insurance, which is also a really good one. Okay, but SoundHound went up to $9, and now it's back to $5. Okay, I think we recommended it at $4, so it's still positive. But it's like, that's the game. All of those positions I want to hold for 10 years. Big fan of those. But yeah, again, what the most important thing we can do right now is wait. Next month's position, I don't even know if I'm going to do one, just because it's like, oh, it's October. We vote in 14 days, like when November comes, it's just going to be a wild situation. And I don't know how the stock market's going to react. I can tell you, this is one thing, and I know I'm going over 15 minutes here. I'll try to be brief. We are in a recession. And if anybody tells you different, I mean this. I really mean this. Take a deep breath and ask them why. What makes you think we are not in a recession? Okay, now the biggest thing is that people confuse the stock market and the economy, and they might say, "Oh, we're in a recession." But how are we in a recession? The stock market's doing super well. Those aren't the same thing at all. Okay, they're not even close. But hold on, they are close. They do correlate. They do correlate with one another, but they are not the same thing. Okay, we're seeing it right now where pretty much every daily item that we might use or purchase is more expensive than it was 4 or 5 years ago. But now the stock market is higher. Okay, the stock market is near all-time highs. I think we're like 10% away from all-time highs, but it fluctuates consistently. Okay, and again, I said we were going to be at 7,000, so I think the stock market's going to keep going up. And part of that is because if we can come out of this recessionary period economically, then all that cash that's on the sidelines, right? If you listen to last episode, I told you there's a whole bunch of money in treasuries, a whole bunch of money in money market, and high interest rate savings accounts, billions, trillions of dollars. If the interest rates go down, that money will come into play. Okay, we'll start buying equities. We'll start buying things more than we will just keeping it in the bank, keeping it in these safe interest rates, or interest yielding accounts. Okay, so that's our outlook. That's our plan on it. Just stay in the game, play the game. Everything's down, guys. Bitcoin's down, gold's down, stocks are down. What do you put your money? Real estate is down. Nobody can sell their house right now unless you're going to sell it to BlackRock. Okay, things are just difficult right now. Okay, so wait the game out. Wait for this interest rates. Speak to an advisor. Speak to us. We have multiple funds. We have growth funds. We have moderate funds. We have conservative investments. We work with pretty much everybody, but our expertise is retirees, business owners, medical providers. Okay, that's really our specialty. And we're happy to help you. We want you to become successful, even if you don't have any money. Okay, buy our newsletter. It's $10 a month. Okay, get started. We're going to be able to help you get started, become successful. And if you have money and you're like, well, I just don't know how to make this work, speak with another advisor. Speak with somebody who's a fiduciary. Okay, stop trying to do it yourself. You might be good at it, maybe, but it could also be better. So what? So if you get 5%, okay, here's a good. I'll rant on this and then I'll end. Vanguard did a study, I don't know how many years ago it was, 3 to 5 years ago, that a financial advisor adds 3% annually to the average portfolio return versus someone who manages it themselves. Okay, that's on average. So that's not even the very best of the advisors. So if you have to pay 1% to somebody to get an extra 3% every single year, absolutely worth it. No question, no brainer. Paying 1% to get 3% makes a whole bunch of sense to me. Hope it does to you guys. As always, invest early, invest often. We will see you next week.